I'm here again with William Lang, founder of Downriver Capital Management. Billy, can you give us an example of a typical small cap value stock that you like?
Unfortunately, the regulators don't allow us to give specific examples in this type of a format, but I can give you an example without using the company's name. So a recent company that we started buying that we really like, actually we've owned it for a little while, but the company ran into problems a year ago. They received what's called a 483 letter from the FDA, which is a warning to the company that they are out of compliance with generally accepted manufacturing processes that you have to be in compliance with to produce pharmaceuticals. So this particular generic drug manufacturer, they actually were forced to shut down their manufacturing facility. And I've followed generics for the last 10 plus years, and run into 483s and haven't run into ones where they actually forced them to shut the facility down. So this particular violation was a very serious violation because they were forced to shut down the facility.
Sounds pretty bad. Why do you like this company?
Well, it always cracks me up whenever you turn on a lot of the business channels. You'll have value managers on there that tell you this great story about how the company's inexpensive and all these great things that the company's doing. Unfortunately, that's not really the way that the world works. Companies that are trading at a dramatic discount to the market, they're trading at a discount to the market because they have real fundamental problems. So with this particular name, the reason why we like it is that we actually do think that it's just purely the pricing is very misaligned with the long-term value of the assets of the company. The reason why is we feel like the downside protection in this company is outstanding in terms of, first of all, they have over $60 million of net cash on their balance sheet. When we say net cash, that means they have $60 million in cash, no long-term debt. And above and beyond that, actually the most important part of the story is they actually have a partnership with the largest global generic drug manufacturer in the country. And what they do is, because they're the smaller partner, they distribute the lion's share of this large company's products in the United States, which in and of itself wouldn't give us any sense of security in terms of owning the name, because they could always change distributors that they use. But the parent actually owns 75% of the outstanding stock of this company. So we feel like this large parent has a very vested interest in making sure that they right the ship.
So can you give us an example of a company that you have researched and decided not to buy?
Yeah, I've always thought that that's the best question that a prospective investor can ask of a manager, because it really gets at the meat of how your research and investment process works. So to give you an example, and usually when you walk away from a name that you've done a lot of research on, it's pretty frustrating, but it's having that discipline to recognize that the risks aren't aligned and it makes sense to walk away from the name. So it's actually the most recent one that we've had some frustration with is a small golf company, and they just have a great brand, which their brand we feel would be a great takeout for one of the larger consumer product companies or even one of the larger consumer golf companies. But as we did our research in terms of digging through the 10Ks and the 10Qs, we came across the fact that they have a lawsuit that's outstanding. And this lawsuit, when we kind of dug farther into it, we actually went out to the U.S. Trade and Patent Office, and they provide the actual drawings of the plaintiff that's saying that this company is violating their patents. And we essentially went there thinking, it's probably a frivolous lawsuit. But when we pulled up the drawings, it's frightening in terms of how close the drawings are to a technology that they use across a bunch of products. And not only that, they've been producing these products for a number of years. So the potential liability if they lose the case, which to us seems like it very well could be the case, could be devastating to the company. So as a result, even though, once again, phenomenal balance sheet, trading at an extremely attractive price and potentially a great takeout for another company, but we're just not willing, because of the lawsuit and that there's a pretty decent likelihood that they could lose it. that we're not willing to put our clients' money at risk given the situation. With that said, if they do settle the suit or resolve it, maybe they do lose the case and it only costs them, $10 or $15 million and they still have a really strong balance sheet, we would maybe reconsider the name for purchase at that point.
So with your tactical ETF product, what is your current positioning?
As we've mentioned in previous podcasts, we feel the markets are dramatically overvalued right now. So on the ETF side, we're predominantly building short positions to protect our equities on the other side.
So which sectors are you short?
We're short a couple of different areas, but our biggest focus or concerns right now, and that's why we've built short positions, are first of all the consumer stocks, second of all commercial real estate, and third of all China. So to start back at the beginning, in terms of the consumer stocks, they have rallied tremendously off of the lows this time last year. A lot of the consumer names are up 200-300% over the last year, and I think the thinking on Wall Street is that because, and this is the way the street works, is that most of the retailers in the last year have been showing slightly modest positive comps, up 4 or 5% in aggregate in terms of retail sales. What people don't recognize is that comps are always anniversarying, and so the fact that before this year, in terms of the stimulus money and everything coming in, that most of the retailers, in terms of their sales, they were down cataclysmically over the year and a half period before that. So comps are so easy that people are looking at the retail space and saying, oh, the retailers are back to the races and are growing sales. But that really leaves out really the bigger picture of really what's happening. I mean, it's absolutely a dead cat bounce. And on top of that, valuations, because these stocks have moved up so much, are at levels that make absolutely no sense. The second area that we're concerned about is commercial real estate, and I don't think we're really out on a limb here. I mean, everybody under the sun has warned people that there's major fundamental problems with the commercial real estate space right now. Actually, if you go to, I believe it's Grubb & Ellis, which is one of the big firms that tracks commercial real estate prices, the actual national office market is running, it's forecasted, the Grubb & Ellis forecast that they'll be running at and I believe it's 18.5 to 19% vacancy rates by the end of 2010. That is a historic high. I mean, that's the highest number that we've ever seen. And so to me, in and of itself, the fact that commercial real estate is having problems isn't really the problem. The problem is that these securities, the equity markets, the guys that have exposure, that own this commercial real estate, their stock prices have gone up tremendously in the last 9 months in the face of absolutely terrible fundamentals. So for us, we feel like it's really kind of a no-brainer trade to be able to hedge out and actually go short on the commercial real estate space. The third piece, which is China, which there have been a number of hedge fund managers that have come out over the last year and really kind of told the story in terms of that they're short China as well. And the issue with China, it really is not a couple of rogue people that have recognized that there's problems in China. I mean, if you look at China's market, once again, their equity markets are stratospheric in terms of the multiples that they're trading at. You also have a property bubble in China, and what people forget is that China, their economy, over a third of their GDP, a third of their economy is based on exports. And if you look at what's going on in the rest of the world in terms of Europe, the United States, the more developed countries, they're essentially the consumers of the goods that they produce. The outlook is it's going to be very, very muted over the next couple of years. So to justify the valuations or the prices that people are paying for equities in the Chinese market, make really no sense. And so we've built a small short position in China because we do think once, like I said, in terms of the United States and Europe, consumption is likely to be flat to declining as we begin anniversarying a lot of the stimulus spending. It's going to put a tremendous amount of pressure back on China that has a laundry list of problems.
Well, thank you for your time, Billy.
Thank you. It was nice being here.